folks. Thanks for clicking on my market report. This is Mike, and this report primarily focuses on mortgage rates and what drives mortgage rates on a daily basis. And we do touch a little bit on the stock market as they do kind of correlate in the markets as they do compete for dollars many times. With that in mind, we'll start off with the economic reports today. We had the jobless claims that we get out every Thursday. So last week's report came in at 861,000. However, it was revised a little bit lower to 841,000. Forecast count for this week at 838,000, and it came in well below that to 730,000. That came in pretty astonishingly low compared to what we would have thought, almost about 100,000. We also got durable goods for the month of January. So December's number came in at half a point, but it was revised higher to 1.5 or 1.2%. Forecast for January is at 1.1%, and it came in much higher at 3.4%. Now, when you take out the big items like the military planes and stuff, we get what they call the core capex or capital goods here. And this is kind of like your core, like what we do with the core for inflation data. We would take out food and energy, take out the variables that you cannot control. And this is something that we're basically taking out the big ticket items that kind of obscure the numbers a little bit here. So, without further ado, we had a 0.7% increase in the month of December. It became revised higher to 1.5%. Forecast for January came at 0.7%. It came in a 0.5%. So this was actually a very good number, especially December's when it was revised much higher. And this still came in just shy of the forecast, but still relatively higher. So good numbers overall. Now we got another revision to the GDP for the fourth quarter. It came in at 4% back in January. That's the initial one. Our final one will come out in March. But forecast accounted for 4.2, and it came up slightly to 4.1%. Last but not least, we got the pending home sales. We had 125 and a half, or yeah, 125 and a half annualized adjusted or seasonally adjusted sales here for units, and for the month of December, and that was revised higher to 126.4. Now it dropped in January to 122.8. So obviously that drop became larger after the revision here from the initial response here. Let's take a look at the headline news. Stocks are down. We're taking a bit of a beating. As you'll see coming ahead, investors are basically selling off, and it all has to do with the yields. We talked about this earlier in the week. It got calmed down a little bit after Fed Chair Powell was speaking before Congress. He kind of eased. He had some dovish comments saying that he thinks it'll take a good 3 years before they obtain the inflationary data or inflationary numbers that they're looking for. And then you get a comment by Fed Esther George that basically stated that after majority of people get their vaccinations, we could see a spike in inflation. So that kind of also spooked things a bit for investors, kind of brought those fears back to them. So again, so markets are reacting to comments about that, but they see the yields keep rising here, and we'll touch on that in a moment here. But right now, we're seeing a huge sell-off, even in the bond market. As you see, we left off here. We started the morning up about 76 basis points lower, and we've been trying to reach our way back up. And since then, we've been kind of dropping down. Even after I've done this, we just had the 7-year auction, and it came in very disappointing. And this has dropped even further. We're down actually closer about the 76 basis points that we lost with the initial here on this. So right now, it's taking a huge beating right now. That means obviously mortgage rates have gone up. That's basically 3/4 of a point in fees for a rate. So to give you an idea what this cost is. So we're not too far off from 1 whole point of what that fee would have been. Here's yields. We touched the 150 range. This is a psychological level we've been kind of seeing, and they really wanted to hit that, and we hit the 1.523. It has kind of subsided a little bit, but again, this is where we've kind of hit that level, the 150 range. So this is the possibility we were kind of worried about, and we hit it. Do we continue, or do we kind of pull back a little bit? It's hard to say. We'd like to see some type of correction, but this is just, it's kind of running amok, basically. And again, this is, so rates are creeping up a bit higher, and we're still seeing a lot of this just unfold. We're seeing yields continue to rise. It's spooking the markets, and we're getting big sell-offs not only in stocks but also mortgage-backed securities, and that translates to higher mortgage rates. And of course, stock prices are coming down because they're getting reevaluated. Higher yields represent inflation, but also it represents the concerns that higher borrowing costs for corporations, and that means less profit for investors. So with that in mind, if you guys got any questions, please feel free to reach out to me anytime. I'd love to be able to talk with you guys. If you guys are looking to refinance or purchase and want a review or assistance in any of that, please feel free to reach out. A little bit of background about myself. I am a loan officer. I do work with a national lender, so we help people in all 50 states. So feel free to reach out anytime. Thanks for watching, folks. I hope you guys have a great rest of your day, and we'll see you in tomorrow's video. Bye-bye.